tried to start with something I started off last year also, which is a little bit of the facts related to the financial crisis. On the left you see public debt. That's one of the things that is here to stay, and if you see the discussions going on in Europe, no matter what country you're looking at, you don't see a turning point in the trend of, let's say, increasing debt levels in the European government. On the right hand side you see the central bank rates, and what's interesting is there is this the end of the ECB a couple of weeks ago, lowering the interest rates again to now a 0.25 percentage point of the central bank interest rate. And the question more or less is this a good or a bad sign for the European economy as a whole and for the perspectives going forward? Because if you look at the European economies overall, you see some positive signs. If you look to Spain, if you look to Ireland, some of the countries that were very hard hit by the economic crisis. On the other hand, you see countries like France where the positive signs are possibly not that obvious to the outsider than to some of the French insiders possibly. So the argument is, what does the ECB know about going on in Europe that she had to lower the interest rates? So I think that's something, it's not such a positive sign, because inflation, yes, it is an issue, but now we are not worrying about inflation as what's the typical fears of the German people is. We are in Europe more worrying about deflation, which I possibly wouldn't see on the agenda that high as some people talk about it today. But I think the sign the ECB has given, from my point of view, is probably not one to make us very confident on the next 12 to 18 months to go what's going around in Europe, especially as it is a sign for the situation of the banking sector and some of the balance sheet of the banks. So I think we have to be aware of what's going on there, and possibly Richard can, one of his typical questions to ask what's happening next year from the banking side in the markets. Looking at the growth, what I already mentioned is we have a quite diverging pattern across Europe, and what we see is that the financial crisis changed really the growth path of a lot of countries. What we see with the financial crisis happening in 2007, 2008 is it changed the growth path from a lot of countries. Looking at Germany and Sweden, today's growth path seems to be steeper than the one we had before the crisis. So we can say yes, everything fine, it's going well there. You have countries like France, Denmark, Norway, where the growth path seems to be parallel but on a little lower level. But looking at France in particular, the question has to be, will this go on like it is? And I think the question is a lot up to politics, but given the necessities of reforms and things that have to be done in France, it will be a hard play for everybody who's active in the country in the coming years, given that from the political side, I think it's very unpredictable what's happening. One week you see the government going right, next week the government will convincingly tell it that it always told that it will go left. So the question always, what will this growth path really be, keep on in the way it had like the crisis, or will it deteriorate in the months to come? And on the right side you have some countries that the growth path after the crisis now is flatter. That's Finland, that's the Netherlands, countries that are still struggling. Finland, given the problems Nokia had, the Netherlands still with a housing market in let's say a correction phase. And also UK is still, although the figures of the last quarters were quite positive on the UK economy overall, the general growth trend is still below the levels we have seen before the financial crisis. Nevertheless, it should improve in the quarters to come, given the momentum we have seen in the last month in the UK. But what we have to keep in mind, and that's also when you operate in the European markets, the disparities in the European Union will continue. You see it on the left with the unemployment rates ranging of below 10% in Germany and Norway to above 50% down in Spain. So that is some of the biggest problems that all countries will face, and that will trickle down also on the investment side. It has an influence on the residential markets, it has an influence on the retail markets. Maybe not so much on the pure office demand side. On the medium to long term, it will also filter through to the office markets. So on the right side, you see a little bit of GDP EU member states, and in the yellow bars, I've added in the German GDP figures on a quarterly basis. You see Germany, or why it is always talk about the German is the growth engine of Europe. Yes, we have in the EU one of the strongest growth rates. There are a few countries that perform better than Germany. Everybody always tells me, yes, Norway is performing better. It is performing better, but it's not an EU country. So that is one of the things why Norway isn't in there. But what we have to keep in mind, real estate is a local business, and especially if you talk about the European investment strategy, European operations, you have to much more focus on what's going on the ground. And Walter Becher from Colliers told last week quite convincingly that fundamentals are very high on the agenda of a lot of investors again. I think that is the point that we have to make in the years to come. It's not so much about the calculations, so it's much about knowing what's going on the ground, and that has differentiated very much in the European Union in the last month again. So overall, I would say, I'm not running through the points, what I want to say, one of the last points possibly, the implications of regulation. That's one of the things I'm quite afraid of. That's the last point I put down here. The implications are quite opaque, and we still don't know what they really will be, because regulation is now much more of a moving target as it has been in, let's say, 5 or 10 years ago. And one of the things that we also have to keep in mind, regulation will not solve the problem of another crisis happening again. It will also only solve the problem of the same crisis happening again. But you can be convinced that the new crisis will be different from the last one we had. So no matter what the regulation is, it will not stop a new crisis happening. So it's down to the investors to act in a, let's say, reasonable manner in a way to understanding what they're doing. On the other hand, that will keep investors, the investment preferences of a lot of institutional investors on the low risk end of the investment spectrum, because they are simply trying to avoid any accessible risk to be in the same position as they had been 5-6 years ago. So looking back at 2013 and will the future be much different? That was one of the questions I asked myself when looking at these figures. Is you see, when looking at the Invest survey from early last year, everybody wanted to invest in Germany, and then there was a lot of talk about that people are moving up the risk curve because you've seen these light gray value add bars a little higher than the year before. I personally would still say you will see a higher interest in value add as we've seen early this year when INREF comes out with the survey next year. But it's just because the investors want the higher returns of the value add strategies. They're not willing to take the higher risks associated with a lot of the value add strategies. Not saying that you cannot have a higher return with not so much high risk as a pure core strategy. So that's one of the points I would say there is a lot of room for the investors to go for. But I think value add for most investors simply means higher return than core, but with more or less the same risk level than core. So that is then the thing of you have to figure out a way how to persuade you. I think that's also you see with the inflationary use of developed to core, broken core, core plus, or whatever core segment you can name it. It's not core, but it's something similar to core. Traditionally, we would have called that value add. But now we try to call it one way of core just to feel the investors more comfortable that we are on the lower risk end. So looking at what happened in Europe with investment volumes, I think the three big countries, UK, France, Germany, they take up a lot of they add up to, let's say, 50–60% of the whole investment volume in Europe, and that will stay this way for the, I would say, foreseeable future, given that you have the liquidity, that you have the interest. Possibly France might be the question, will the interest remain that high? I would say yes, it's still one of the liquid markets if you look at the Ile-de-France market, so there will always be demand for investments there because you can enter and exit quite easily. But nevertheless, given the economic situation, that might be one of the things to change. That's the thing I talked about, because I think that is the interesting point. The investors don't want to be in that core segment anymore because they realize we need the higher returns. So I think the interesting point will be how do investors and asset managers deal with the problem getting in this yellow value add bubble on the lower risk end, and that can be something working on the rented asset, as I pointed out, or residential property resale, residential property wholesale to retail conversion in residential. One of the strategies. If you do this in the central in the central area of a metropolitan European city, the risk level is not much higher than it is in buy and hold residential in this city, because there is a demand for buying but you can generate considerably higher returns. The same is working an under-rented asset, adding value on the asset management side. That's one of the things that are high on the agenda, and that's what you see with a lot of asset managers and investors are going for, because it gives you a higher return, and if the location of the property is a long-term core, or whatever you might call it, location, because the location is the key element of the property, it gives you the long-term returns, and it can give you enhanced returns if you're willing to work with the asset. But it also means you have to be able to work with the asset. It's not so much about benefiting from low leverage if you try to generate the returns. It's about benefiting on the asset management side. So we are pretty convinced that the future will be in these yellow value add bubble. The question now is what kind of strategies can come up from the asset and investor side. And what this means with value add is that local knowledge is one of the key points that comes to the market, that the fundamentals are coming back into play. And what I just looked here is one of the 27 European office markets PMA is looking at. And if you look at the, let's say, top 5 markets, they add up to more than 53% of the whole take-up in Europe in the last year, in the first 3 quarters of this year, sorry. So the top 3 markets being London, Paris and Brussels, they add up to 30%, then the top 4 German markets are following. And then you have 50% of the whole take-up of these 27 cities. So that also, what it also means is that everybody who tells you he's getting outside the top cities needs to have a very strong local base to really understand what one of the take-up level is going on in these markets. So it's one of the things to say, yes, we're going outside, but you really have to have the platform, because the majority of what is covered on the markets, and that's also what is PMA representing here, is going on in these big 5-6 markets. So if you're outside these markets, the local knowledge, the thing of being local is one of the crucial things you have to be aware of in the coming months. And now, being a residential player in PATRIZIA, one of the things we are pretty convinced is that the residential story will continue for the next 12-18 months, because it is a bond surrogate, because the cash flow is very, let's say, unsensitive to fluctuations, because if one tenant is not paying, you simply don't recognize as you have a large enough portfolio. And on the other hand, the yield spreads towards government bonds, what I try to put on the map with these grey bars here, they are looking still quite attractive, and more the investors, let's say, voice that they want to be in residential. The thing now is, do we see really investments happening? We've seen a lot of interest in the UK, very few actions so far. You see a lot of product coming out in the Dutch market currently, not very much interest in investing there so far. You see political interest in the resi market in Poland, nothing happening so far, despite that the state-backed bank now announced that they will operate a residential listed company in Poland in the coming years. But the crucial question now is, the residential momentum is still going on. What will we see from the investor side in the years to come?